on Sky News Business. This is Trading Day, the close.
Great to have your company as we go into match-out mode this afternoon. It is the final trading day of May. The sell in May, go away. Well, yeah, you kind of left your run a little late on it. Yes, it's happening, but not across the last 31 trading days in aggregate. Yesterday, though, down about 0.5%. And we are seeing fairly broad-based liquidation of positions. And not least of all in that banking space, the 1% plus decline for CBA. It marks it out as the worst performer in class today in that sector. Best performer, still in the banks, the NAV, but still a loss there of about 0.2%, 0.3 really. But that's an outperform v that positioning you can see for the rest of the sector. Looking at some of those material plays today, not least of all Fortescue, securing the second towage licence at Port Hedland. That news coming through after market close yesterday. We are seeing a good bid kick in alongside that stock, about a $3 a pop. Share price, it's a rise of about 0.7%. Tokyo has just closed today with only a 1% bounce to finish up around the 17,234 level. And so there you have it there. The broader topics, incidentally, up about 1.01%, so doing slightly better, that market. And we're looking to Europe as well. Interesting developments as that market looks like it'll fall. That's to say the FTSE, IG calling out in its opening calls losses for that index today, not least of all as well, probably for the CAC 40 in Paris, Spain's IBEX and the MIB as well, looking to decline. Just the etc. DAX should be in the money early on this session. Let's bring into play my panel for the next couple of hours. Francesco D'Estrades from Ord Minnett and Pete McGuire from XM Group. Gentlemen, welcome to you both. And we haven't even got into other themes roiling markets, not least of all a pending OPEC meeting.
Next week.
Countdown's on, right, to that one. Aramco very much in people's minds, a listing, so kind of an ulterior motive now with someone who might be chairing OPEC.
Could well do, Carson.
So watch this space. What are both your broad thoughts about the commodity piece and equities? Let's start with equities. How do you like this month?
Well, selling May and go away has gone away, hasn't it, really? I mean, this month's been a positive month. But I think the beginning of the start of the year was obviously fairly negative, very negative. So I think that's sort of compensated for it. Look, I'm not too concerned where the market is at the moment. You mentioned the banks come off a bit today. I think they're probably trading at the top of their range. So, traders are probably looking to take a little bit of short-term profit off the table. But, for longer-term investors, I don't think there's any need to panic on those sort of things. Looking across the broader market, I mean, really it was a pretty non-eventful day in the markets for us. So, commodities are doing what they're doing. I mean, you're going to talk about oil, I imagine, in a minute. But, there's a bit of talk about the Chinese with the steel producers trying to encourage a bit more steel production. Don't think that's going to change the price of things, really. I mean, the short-term prices of iron ore is moving around are fairly volatile. I don't think it's warranted. I think, the iron ore is probably destined to stay around these levels, maybe a bit lower. So I wouldn't be jumping too quickly into iron ore producers at this stage either.
What about energy ones? Because,
I like energy.
Because it's they're pushed back to 50.
Yeah.
Close above 50 is the key, though, isn't it?
Well, look, I'm not a technical person, and I don't think there's obviously emotional ties to certain price levels and things like that. But look, I think when the oil price went down below $40 a barrel, it was cheap. I didn't expect to see the rebound we saw a couple of years ago when it went down to $40, went back up to 100. But this nice recovery is, I think, really good. It sets a nice platform for the oil price. Look, the difference between oil and iron ore and the other commodities is that the demand for oil is fairly elastic. So when prices fall, then demand will increase a little bit more than it will for the other commodities.
Those levels, I mean, I know Francesco's not, saying he's in any way motivated by them, but it's sort of a momentum trade as well, is it not?
Absolutely.
When you get to a figure like 50 and you either breach it or you remain under it.
Well, that's right. Well, you've got the speculators and the producers, and what we're seeing is that the implied volatility of deep out of the money put options has certainly ramped up in recent trading sessions. So there are many traders and speculators saying, are we going to see a price correction back to 44, 42 or 40 leading into the next months or all the way out to the end of the year? And that factor has to be considered because people are hedging their positions, and of course the other side where traders see an opportunity to participate and also make a very large windfall if the price does collapse quickly. So all of that, we've got a meeting next week. The storyline I don't think has changed too much with the new Saudis, or the Saudi minister there, and of course where the global footprint, we're still going to see a very interesting over the Northern Hemisphere summer.
Okay, factor in all of what you've just said to our next guest as well, because data dropped today looking at the trade deficit in the March quarter, 8.1 billion. That's an improvement, though, on December, despite the weaker terms of trade. Let's bring into the discussion on this one our next guest. That's Gareth Ed from Combank, no less. Warm welcome to you, Gareth. Already we're seeing a clutch of economists scurrying to revise upwards forecast on GDP tomorrow. Are you in that camp? It seems that you would be.
Yeah, afternoon, Carson. We were indeed in that camp. Couple of stronger bits of data today than expected. We had that net export figure coming better than we'd forecast, and also the public demand, public spending figures also came in a bit better than we thought. So we did indeed revise up our forecast, and we think we're going to get a pretty strong print tomorrow.
And on an annualised basis, what are you seeing there? What do you look at? Perhaps about 2.7% or thereabouts?
We're a little bit higher, actually. I think we're up on the top end of the peak tomorrow. We've got annual growth coming in a little bit over 3%, which should be quite a remarkable feat, really, given the headwinds to growth at the moment. We're still working our way through a downturn in mining investment, but we're going to get a big kick tomorrow to growth from net exports. And most of the other components on the expenditure side of GDP look like they're going to contribute to growth. So, yeah, we think we're in for a good print tomorrow.
What are your thoughts on the implications of this wage review decision as well, and what that might do to inflation? We've already had the likes of the Retailers Association, the Australian Industry Group condemning this for being an unwelcome pressure on businesses. Do you see this being a pressure in an upward direction on the inflation piece for Australia?
Yeah, I was just across those figures just before on the way here. It looks like they're going to mean that wages grows at that end of town a little bit more than where current wages across the border running. So yeah, that probably has some small upside on both in wages and inflation. But look, most people employed out there aren't on those at that wage level. So I expect the impact won't be huge on either the overall inflation numbers or the wages numbers.
Although you concede with the push ever more into part-time roles, as AI Group points out, those in that zone hoping to secure additional hours, there's a risk that this decision will be to the detriment of that very class of employee or prospective employee. Would you go as far as agreeing with that sentiment? Oh,
look, potentially. I mean, I haven't read all the ins and outs, to be honest, on today's decision. But look, I don't think it was a huge lift anyway. So, you know, I suspect we'll see as time goes on exactly how that plays out. But I wouldn't think it would have a huge impact.
When it comes to the GDP as well, and you make a reflection on Q4 of last year, just remind us of that number. And have we seen the high watermark of growth, or you're believing still there's enough momentum to push us back into that position again?
Yeah, we got a good print last quarter, and also in that print we saw an upward revision to Q3. So what that did was take the annual growth of output in the economy to close to 3%. And as I said, yeah, we think we'll get a good print tomorrow. Our forecasts, though, going beyond that have growth in Australia coming down a little bit below 3%. So I think that the back end of last year and the first quarter of this year probably will be the high points in terms of growth, and they also correspond with when we saw that pick up in employment growth. So, but overall, I still think that economic output, or GDP growth, if you like, in Australia is going to be pretty firm this year, and it'll be somewhere probably a little bit under 3%.
So, Gareth, what does this have impact upon your forecast for interest rate changes?
Yeah, look, we still think we're going to get another rate cut, probably 2 this year. I think, you know, the Reserve Bank's made it pretty clear that inflation's guiding their rate decisions at the moment rather than growth. I mean, we had good growth in the fourth quarter of last last year. Those figures came out in March. 2 months later, the Reserve Bank cut, and that was purely because of the outlook for inflation. I don't think tomorrow's figures are going to change the outlook for inflation. I still think it's going to be soft. I think wages growth is still going to be weak because there's plenty of slack in the labour market. And if you look at the underemployment rate, which is basically the people out there who are working but would like to work more, that's still pretty elevated, which to us means that there's not much pressure that's going to come through on wages, and that underpins our view that even though growth should be pretty good, the inflation outlook will mean that the Reserve Bank will ease again this year and probably twice.
Gareth, just a quick one. Where do you see the Aussie trading, say, September, October?
Oh yeah, look, a lot there depends on the Fed. I think the Fed's going to raise interest rates over the next couple of months. That'll put some further downward pressure on the Aussie, I would think. It's hard to pick a point exactly where it's going to be in September, October, but I would expect the levels that it's at now are probably where it's going to trade over coming months.
Okay.
Always good insights. Thank you, Gareth. Appreciate it.
Cheers, guys.
Gareth Aird, economist at CBA, at ComSec, no less. Let's take a short break for you. Coming up, I'll go direct to the desk. Andrew Weiland, Dornbush Partners in Toowoomba. His take on volumes and what clients have been chattering and nattering about today. Welcome back into the show. A reminder on finishing levels on this market this final trading day of May, losing just over 0.5%, contributing to that decline some fairly sizable downside moves in the energy space. Woodside with a 2.4% loss. Oil Search down by some 1.3%. Incidentally, reports out that it may need to increase the cash component of that offer to win over Interoil holders. So there you have it. Oil Search and a cash conundrum potentially on any tie-up with Interoil. Again, we've seen Rio making headlines. That's in light of the fact that you've seen those iron ore price declines for the third session in 4. That's the Metal Bulletin's latest read. So it's disproportionately feeling some of that pain. Really interesting, incidentally, just to see in that match out how Fortescue, having rallied, ran out completely out of puff. Not sure whether we can even animate into the material sector, but we might do that shortly just to give you a view on things. But speaking of end customers, China, with other news that it's now front and centre on, and that's to do with the tie-up with Virgin Australia. The country's biggest private airline operator in China is taking a 13% slice of Virgin, and that is going to boost that registers access to the burgeoning Chinese travel market. So it was important for John Borghetti to ink some kind of a pan-Asian tie-up, and it seems that that's now looking quite rock solid if it gets the clearance from Chinese and Australian regulators. This is the HNA Aviation Group involved with a 159 million equity investment in Virgin to take a 13% slice of the action. This has all come, of course, as Air New Zealand, Virgin's previously largest shareholder, is looking at a full or part sale of that 26% stake.
This alliance is immense for us. I mean, when you consider that we've done an alliance with a huge business in the HNA Group, which, as you know, is a Fortune 500 company, to provide transport and cooperation between Australia and China, China being the biggest inbound travel market and growing at an incredible rate. I mean, you look at the growth rates, and I think it's about 22% on the previous year, and it's been growing at about 18% every year since 2010. This is a massive arrangement for us, but equally a very, very good arrangement for Australia and Australian tourism.
And the shares were rallying today. I might just bring you a latest read on that one. Virgin VAH was up some 7% in the event. Other news, Aldi, the most profitable supermarket in Australia and likely to significantly disrupt the majors Coles and Woolies. This is according to a UBS report, forecasting sales at Aldi will grow 15% every year for the next 3 years to top the 10 billion mark by 2019. And that means trouble for the duopoly, the incumbents. Audi could take at least $1 billion in sales from Coles and Woolies every year, according to this report. We saw Woolies down 1.25% and Wares off 2.1%. Flexi Group shares hitting their lowest level in 4 years on a profit outlook. The company's flagging profit for the year and next to be lower than previous estimates. Now seeing FY16 coming in at 97 mil, flagging the potential sale of some units, including Blink, Think Office Tech, and Flexi Enterprises, a 6.8% swoon on that news. Incidentally, just thinking back to those remarks from John Borghetti, not to sort of be a pedant or anything like that, but all the talk today had been that HNA is a Fortune Global 5000 conglomerate, not a 500 entity, and that was on the lips of John Borghetti. So, okay, we'll toss that one up into the air and see where it lands, but you can debate it. I mean, HNA, had you heard of this one before?
No,
HNA? No, I mean, it's Fortune 500 v 5,000. It's somewhat different.
Just a little bit. Just a little bit, yeah.
We'll perhaps do a little fact check of our own, independent of those claims and what certainly the press reports are saying. Andrew Wyland, maybe he's got a view. The managing partner and Dornbush Partners via Skype, live in Toowoomba. Andrew, welcome to you. What is it to be, Fortune 500 or Global 5000 conglomerate for HNA?
I'll put my hand up. You actually caught me looking up Wikipedia.
Carry on. It'll save me doing it.
Okay, just chat amongst yourselves for a moment whilst I have a look. It's founded in 2000. It's involved in financial services, tourism, logistics. Wikipedia saying that they've been spending about $3 billion on acquisitions, and its goal is to be one of the top 50, I presume that's global companies, by 2030. But yes, unfortunately, Wikipedia a bit light on details.
All right.
Well, I understand it's China's biggest airline company, but I don't know how good those sources are.
Well, and the other point about that is, you know, names that roll off the tongue, the likes of Cathay Pacific and China East and China Southern, this is not part of the...
Doesn't rattle off the tongue, does it?
No, it doesn't. So I'm just wondering, Andrew Wyland, to you, if this is a private airline group, what traction realistically will they be able to gain? What foothold will they offer? And Bridgehead?
Well, and again, without labouring on the Wikipedia thing, just reading it, you know, they seem very strong in tourism, and you know, whether they can make that sort of connection. I mean, we saw Webjet as an example being able to do it quite successfully with their airline business, or airfare business rather, and also their accommodation. So, you know, whether it's just a bigger version of that. But, yeah, I mean, I think the party here that would be terribly unhappy in all this is, of course, Air New Zealand, who are trying to extract themselves, and this would have been the perfect opportunity.
Well, to have rallied today by some 7% plus, I mean, the point being this is a very liquid register, right? So those sorts of moves kind of somewhat misrepresent the real activity on the register, right?
Yep, no, I agree. And look, I mean, as you know, I just don't like airlines, and you know, when you've got the fact that the oil price appears to be getting its acts back together, you know, we're seeing a bit of weakness in Qantas. I note that you know, people are saying Qantas is now the next short. You know, it's probably fortuitous timing for Virgin to be getting this away.
We wouldn't arguably have been in this position, Pete, had it not been for bad oil hedging strategies made by the airline. Now, these are done
We had
US
huge
dollars.
currency moves as well.
Exactly, and they're done in US dollars.
So what you've had is you've had the two major inputs creating, from a hedging perspective, a very, very tough time for CFOs and boards to appreciate. And then you had a price collapse, and so in turn it rolled into, I just think, a bit of a nightmare. Yeah. So in turn you've got the big guys out of the Middle East starting to win markets, and they're becoming far more competitive with new players realising that that centralised hub in the Middle East is just a perfect vantage point. And of course, with cheap fuel, they might be the next, well, they're their true competitive advantage.
Is it excusable, Francesco, or if you're an airline hedging division within Treasury, should you not be
You're hedging half your book.
The crop?
You would have been hedging half in your book about a month or two ago, I would say, or at least starting to hedge, because you know the oil price couldn't have got much cheaper than its low point there in recent times. But look, you know, airlines are a punt, you know, and Qantas was a bit of a gimme when the oil price started falling, but no one knew how far that oil price was going to fall. Now that oil price is starting to turn, well, it's obviously not going back to $110, well, I don't think, but, you know, trading around 50 to 60, maybe $70 at a high, you know, Qantas is going to sort of start to feel a little bit of that pinch then, unless they've hedged a lot of...
a long way out.
Yeah.
And I agree, $70 in my mind is sort of the ceiling. At that stage, the US fracking guys start becoming competitive, and our Saudi friends won't want that. So I would suggest $70 is probably the high watermark.
When John Borghetti waves his wand and talks about abracadabra, China the factor, do you, to clients, Andrew Wyland, say, yes, we're on for the ride, or exercise caution in light of the experience of late thrown up by Blackmore's, Bellamy's et al.?
Sure. I mean, I think, as I said, airlines per se, we're just cold on. But, you know, as I mentioned in my little talking points I sent through earlier, you know, I was talking about my recent trip to Cairns and, you know, talking to the various tour operators around the Cairns region, and they were suggesting around 85% of their current numbers are based on Chinese tourists coming through the door. And, you know, in that little piece beforehand, you know, talking about that growth that they're seeing, you know, 18% plus growth per annum. So, you know, I'd be more inclined to play it looking at, say, like a Mantra or something like that. Interesting to note, though, of course, Mantra have also just done a placement, so they obviously think their share price is pretty high. But I'm certainly happy to play the tourism gain, in particular with that falling dollar, albeit today's slight gain in the dollar, but certainly wouldn't be doing it through airlines.
Understood, understood. Let's talk your top buy now, and onto that list, Aristocrat.
Yeah, look, we like Aristocrat, and certainly the fact, one of the things they were highlighting in their earnings update recently was the fact that around 50% of their income is now annuity or recurring style. You know, they've got some pretty strong earnings growth coming through there, certainly diversified as well, with some good offshore income. So certainly one that we're liking, and, you know, from the point of view that it's trading on a P of 22, look, 22 is pretty high, but relative to, dare I say, Domino's, you know, I'm probably happy to pay 22 times for Aristocrat.
Meanwhile, getting out of Technology One, if so, why so?
Well, again, not so much that it's a bad business, but, you know, you're looking at a PE of 41 times. You know, we were sort of buying it in the high threes, low fours, and, you know, what's it now, around $5.50. So, you know, when you're being asked to pay 41 times earnings for earnings growth, that's meant to be around 20%. I mean, 20% is impressive in this type of environment, but not going to pay 41 times earnings for it. And, you know, we'd just like to see it pull back into the mid-fours before we started looking at that again.
Speaking of pulling back, we pulled back below 5,400 today. So in light of the Jeff Wilson comments that have now been mentioned twice on the show, back to back, so without giving too overweight a ponderous note on it, but what are your thoughts?
I mean, I think the takeaway is that out of the last 7 Junes, 5 of them have been negative. And if we have a look at May, I mean, obviously today's figures will sort of change a little bit, but I think May's been up around 3% for the month. So it's quite unusual for May to be strong, and certainly by that quantum. Coming into end of quarter, fund managers squaring away their books, all that type of stuff, it would not be unsurprising at all to see some weakness in June. Of course, late June, we also had the Brexit vote, and then our friend Donald Trump and all the excitement around that. So there's certainly plenty of variables in play there. I agree. I think the next few months are going to be pretty tough, and if you haven't been taking some profit by now, now's the time to be doing it.
Speaking of which, the other concern is, and this is coming from Sir Linton Crosby, the puppet master par excellence for David Cameron, knighted recently for services to winning elections in the UK, but saying it's now too close to call, and particularly that immigration fear campaign that's really for the Leave camp, looking like it's reaping big dividends. Andrew, your thoughts there now, really turning the tide on this vote?
I mean, I don't profess to be a diplomatic expert at all, but just talking to expats or people even over there, it is such a mixed bag. There is no clear trend, and like you're saying, when you got Linton Crosby being thrown into the fear campaign, you're right that immigration is a real hot button there, that sort of apparent lack of control over their destiny. Now, whether that's true or not is another story, but that hot button is really being pressed on the fear. It really is going to be too close to call.
And ultimately, the European Economic Union was to build around trade. I don't think it's going to have very short-term implications for trade anyway, because generally they'll find a way. Right. Exactly right. Yeah.
Nicely put, and great to talk to you, Andrew.
Thank you. See you next week.
Look forward to it down in Sydney. Andrew One there today, though, in Toowoomba for you. We'll take a very short break. When we come back, we'll take you to CMC's Mike McCarthy. Check in on his perch, how he viewed this final trading day of the month. In just a moment. Welcome back into the show. Mike McCarthy is joining the program live from CMC, not from his usual position though, but from our CBD studio. Welcome into the show. What do you make of this, the final trading day, volume-wise even?
Well, volumes were forecast, and to be frank about it, although we did see a pickup after the data release, overall market traded around 80% of an average day in cash terms, and for futures it was even worse, about 2/3 of an average day in terms of volume. So really not a lot of commitment either before or after the numbers released, but it was definitely a market of two halves today. We're under a lot of pressure early on. Market was down by more than 40 points, approaching a 1% fall before those building approval numbers came out and shocked the market, and a big turnaround in the trading and in the mentality of investors today. Saw it rise to almost get into the green towards the end of the morning session. Of course, that selling pressure did reassert itself, but it was still a better day than it otherwise would have been. And of course, naturally enough, with those building approvals driving the activity, it was the materials sector that was the standout performer. It was down with the energy sector, the worst performer on the day early on. It was helped a little by some support for gold stocks early, but when those building approvals dropped and support for the builders came in, the James Hardys, the Fletcher Buildings of this world, that pushed the materials sector itself back into the green, and that was probably where the ballast was in the market today. Having said all that, it's interesting to note volatility rose in trading today, back up to 16.5% as measured by the index. So it's pretty clear, even though we didn't have a bad trading day, there's still some concerns in the market, and it was a fairly ordinary underperformance from the Australian share market today, with some good gains in the region. Tokyo up by more than 1%, and mainland Chinese shares up by 3%. So a very disappointing trading session for an Australian investor today.
Without asking you to sort of be a Bill Evans Mark II on us with the data, but in fairness, Westpac's come out to say, and I know a clutch of economists were blindsided by this release, but saying, look, if anything, the tightening in lending conditions for investors domestically, the efforts to rein in non-residential purchases mean the segment is cruising for a bruising. My paraphrasing, not theirs, but they're saying, if anything, the segment is coming under additional pressure, and the uptrend is unlikely to sustain, maybe prone to sharp reversal in coming months. Do you think the market has read this the right way?
Well, Carson, it is a bit of a surprise, but the market mentality is that we are looking for a pullback in residential housing in particular. We've seen strong gains, particularly in areas like Sydney, up 15% 2 years in a row. Those sorts of gains are very hard to sustain, so it's not a surprise to hear people calling for further softening. The confounding aspect has been exactly this. The prices have not only held up, they've gone higher, and the activity doesn't seem to be dropping off. So while I'm certainly very aware of a lot of calls like that, and I have respect for many of those commentators, at this stage the numbers have been running directly against them, and I haven't yet heard a good explanation from those calling for a crunch in the market.
Nicely put. Okay, Virgin and HNA, is this the natural fit for the airline? Is this the eureka moment for the stock to take flight?
Well, it certainly gets them out of trouble, and with Air New Zealand announcing its intention to sell down its 26% stake, they desperately needed a new partner. It makes perfect sense from a geographic point of view. China, obviously one of the key drivers of inbound tourism for Australia, and the announcement of direct routes to China from Australia, flown by Virgin, is obviously a part of that agreement. Now, it's not a huge stake at this stage. We're talking about a 15% stake, but I'd suggest with that 159 million that Virgin have raised, a lot of pressure has been eased. It's not impossible we'll see further issues of shares to HNA over the coming years.
Who would be selling, though, to match their desire to increase to 19.9, I suppose? If John Borghetti says that they discussed their desire to get to that level ASAP, who would be the likely drawdown further, a further dilution of whose holdings?
Well, clearly Air New Zealand is the candidate on the block here. They have moved some of their shares, but they still have plenty left. It would seem, I would be suggesting that there are discussions going on right now between HNA and Air New Zealand about getting HNA up to that 19.9.
Other issue there is, what does this spell, given Air New Zealand's desire to get out, to Virgin's push on that domestic NZ route and making inroads there? It seems as that was pitting them head-to-head with Air New Zealand, but equally it's a lucrative, otherwise pretty cosy monopoly, you could argue, across the Tasman there. Does this thwart those ambitions finally and fully?
There are a number of analysts who felt that Air New Zealand's statement just a few weeks ago was a throwing down of the gloves on exactly this issue. They look to be taking on Virgin, and I suspect that the new routes to China are part of Virgin's response to what looks like a stiffening of that competition. You're absolutely right. It was a fairly cosy setup. There was some evidence that things were getting fractious, and given that the international component of both Virgin and Qantas's businesses that is under a lot of margin pressure in particular, it's good news all round, I think, here. Air New Zealand will be relieved that Virgin have somewhere else to go and somewhere else to try and cultivate margin. It means that a stoush that might have hurt both players has probably been avoided.
Let's end on Flexi Group. Pain on the register today, 7% weakness on shares, 4-year lows to be precise. It says it's shuttering its non-core business, so focusing on the leasing and rental finance part, that is the rainmaking divisions. Are you confident that they can flourish with a reduced spread of interests?
Well, it seems to make sense, today's moves. The one question investors might have is, why has it taken so long and how did they get to this point? It's pretty clear from the data that was published today that the return on equity in some of those businesses has been much less than impressive, and perhaps action should have been taken before this. Having said that, they are clearing the decks. I don't know that we can be confident that this strategy will work. They're certainly focusing on their areas of competitive advantage, and that just makes good sense from a business point of view. I think what we can say today, though, that management have finally acknowledged the problems that were plaguing the business and has been driving the share price lower for months now. And in that acknowledgement, although we don't know if their action plan will work, at least they've made a step in the right direction.
Michael, thank you as always.
Thank you.
Panel, your thoughts on this? Rewinding to March, this company, Flexi Group, ticker code FXL, we might bring it up on charts because it's actually down almost 27% this year before today's selling carnage hit home. So it had already been on Skid Row, but it came out when it bought F&P Finance, Fisher & Paykel Finance, and said we are going to up our net profit after tax in the event, and so that was reasons to cheer. But to come out today and pretty much say those optimistic calls are looking very much
with a little bit of headwind.
Yeah. Investors have got to have confidence not just in the business and the assets, but also in management, and that just takes a lot of confidence away in their ability to understand their business and ability to understand sort of how their business is travelling. I mean, so what is it, a couple of months since they've been
future cash flows.
Yeah. Sounds like they're just writing these businesses off. They're not selling them or anything. I understood that they would just shut them down and that's it. So really, there's not even any reward for the asset or anything like that.
What would also the spell when you've got the likes of GE Capital shuttering, you've got Fisher & Paykel Finance. This is an industry thick with regulation now more than ever. In the wake of GFC, reassessing. Frankly speaking, it's more of a hindrance than a help. So to go and buy what's then perceived to be a lemon by the incumbents, what do you really know that they don't, who have been in the game for a whole lot longer?
Well, maybe they know a lot that we don't know.
Right.
You'd have to think that. I mean, when it comes to strategy, and everyone's got their own interpretation, and they see future cash flows, they see opportunity, they see how to grow your business. Well, they must have that on the radar. Well, it must be there.
Potentially management's looking for a good news story too. You know, they might say, well, you know, these things aren't travelling too well that we've got on the books. We buy this sort of shows that we're actually doing things, but the strategy is flawed because the assets that they're holding are still flawed, and they're not really assets. I mean, it's a business that really doesn't hold a lot of physical assets, so it's hard to...
It supplies a service.
That's right.
A lot of call centres, a lot of cold calling.
Service orientated, and it depends on how they derive income from that. You're talking about competition, and there could be new players coming in. It makes it a very it's a highly competitive industry.
And where are your margins with rates at rock bottom levels in any event?
In some ways it's a race to the bottom.
Yeah, and you're dealing with customers that aren't getting the good rates from the quality lenders, So, a personal loan, I don't even know what a personal loan's rate would be at the moment, but let's say, for instance, you go to a bank, you might get it for 6%. I don't know. But they're going to be charging 10. They're going to be, because they're taking on riskier customers.
Right, loan sharks.
Well, yeah, that's a harsh call, but,
there's a margin, there's a clip on the ticket, and if they've got a lot of clients, it's a great business to be in. You just got to grow your book.
Do you also think that this is something that tracks unemployment in the broader economy? So the worse things get, yes, perversely they do better. On the other side of the ledger, when we're seeing numbers like we're seeing on unemployment here, which defy naysayers and go lower and lower, actually this type of a business has got less resonance, less currency.
It's a hard one
thin bow to draw.
It's a thin bow to draw.
Right, okay. There'll always be demand.
I think so. Absolutely.
Your demand's going to ebb and flow with the economy and things. But as far as sort of, when things are tough, people tend to borrow more from riskier sources. I don't think that's necessary. And look, I don't know the data on that, to be honest with you. But personally, I just don't see that.
You'd be out of it. If you were in this, you wouldn't.
I haven't been anywhere near it. I haven't looked at it in a long time. And look, if I was investing in it now, I'd be very seriously considering an exit strategy, and it could be just straight away.
Broader thoughts. A stock like Vita that does credit checking. Are you liking that type of relative monopoly in the marketplace? So building up databases and banks of data on consumers, which you can monetize and basically sell to X, Y, and Z corporate.
Sell those services off.
Oh, look, there's ability to those services, and obviously, those sorts of businesses like Flexi Group, obviously when there's high demand, then they're going to be pushing a lot more on those services to understand what their customers' ratings are like. So, look, I'd have to have a closer look at Vita, but there's a lot of ability to the high level sort of approach to that.
And was subject to a takeover in any event, so that's kind of not in play.
Well, there you go.
Even if you wanted to. Wild card, but staying with the V's, Virtus, some relatively bad blood over IVF just in the last 12 or so hours. Another network, a show on IVF, pointing to volume versus ethics in the business. Do you like this kind of a story, a Virtus play, or on reproductive services in the marketplace, or do you see that as a clash between good ethics and the bottom line, and not really liking the consequences there?
Look, I like the healthcare sector to start with, and there's a lot more demand for these sort of services in the modern society, if you like. So look, there's a lot of demand there. I don't know the business too directly as far as their numbers go, but
because the probability of actually conceiving is what this is getting at is so low exponentially the older you get.
Yes,
that you're clipping the ticket to employ that language, but you're not getting an outcome, and ultimately sooner or later. You're not collecting revenue on outcome. You're collecting revenue on the service. Of course.
Okay, and the customer, if you like, understands that there's no surety.
Do they understand that risk? As opposed to the question.
Well, I understand that it's explained pretty well just through talking to people that have been through these processes, and people that go through these processes are prepared to. Well, they're prepared for disappointment, and they're prepared for another crack at it. So I think you'll find, and it'd be interesting to see what those numbers are, that people that go and use these services, how many incidences they have to go before they're successful at it. I don't know what the answer is.
There are cases of 30
plus repeat visits. And people are going to the childbirth stages later in life these days, which means there's a lot more of that.
Okay. We ponder and pause that particular story. When we come back, the worst and the best performers that marked today's session. Incidentally, some calling this particular month of May the best since 2007. Go figure. More in a minute. Welcome back into the show. Let's look at that finishing level on markets today, marking the end of May. 53.78 and change. There are the best performers in the session. Panel, anything of a trend there? I mean, Select Harvest has got a kind of a yo-yo-esque mentality about it at the moment. It can be on that chart one day, on the worst the next.
Yeah. There's no consistency amongst those best performers, is there? You've got a bank, you've got a LNG company, a resources company, media. So there's a mixed bag there. Select Harvest is, I think it's a good business, but the share price has been fairly volatile, like you mentioned.
Let's switch. Let's go over the page.
Losers.
Well, Lord Mining Services once were warriors. In that regard.
That was a $20 stock.
Oh my gosh, I used to go to the west and see their building signage sort of emblazoned and burning 24/7. Shadow. How the worm can turn on that. We were just talking about that May 2007. Best finish today.
Yeah.
So it's kind of almost back to the future.
Yeah.
Broadly, but these ones were not along for the ride today. Again, Flexi Group, we've talked about that one, and really disappointing on its guidance, having to downgrade and looking as if the synergistic benefits of that F&P finance purchase have just not run according to plan. NAB, not NAB, National Storage rather, on that list as well. Incidentally, NAB's preparing a $750 million plus hybrid issue, but that's a separate story.
Which will go to $1 billion plus.
Because that's the point. We have seen it's obviously.
Westpac just did one, and they started at 750. I can't remember what it came in at, but it was over $1 billion.
Pills 9, I think.
Yeah, and they're attractive. The margins on these things. I think can't remember NAB's one's 4 points something up to 5% margin above bank bill rate. Now, if you're going to put some money in a term deposit, you're only going to get 2 to 3, less than 3%, and you can go and buy one of these things at $100 face value, and you're going to be given, 4.5% to 5% plus the bank bill rate. Well, it's a bit of a no-brainer.
It's better than buying bricks and mortar.
Well,
or not. No,
there's risk. There's risk. They're converting, so they can convert. So there is the element of equity risk in there, but a lot less than just owning the shares.
Your thoughts?
Oh, I think you're right. I mean, if you're looking across the property on that, it's very, very, very hard to say that we're not at a very over-toppy market.
Yeah.
I think it's pretty well maxed out.
Yeah.
And it's going to be interesting how that plays for the rest of the year and certainly into 17.
You mentioned property. We were talking property before. That Lendlease put out an announcement, I think today or yesterday, that they just sold
300 or 400
another tower in Barangaroo, which over a weekend sort of thing. And I haven't read the announcement, so it was only fed to me third hand. But apparently it was a lot of non-investor.
This is Darling Point. Darling Square, rather. Darling Square, right?
Yeah, was it? Okay, I don't.
I think it was.
Front page of the Fin yesterday, or page 3 or thereabouts.
Yeah.
But yes, the idea being, as you rightly say, these were domestic purchases, not the investor piece.
Non-investor, And Lendlease, when they put out the results for the half year, I think they were, mentioned that the defaults in the pre-sales are only seen at about 1%. So that's still below what the norm is.
$780 for a one-bedder, no parking included. It starts to look, as you say, maxed out. And some, right? Even like
3.5, I think they were for 3 bedders. I mean, that's a big ticket. And to sell out in a matter of 4 hours proves to you that the market's certainly strong, but the reality is Homeland may be a little bit of a mixed bag.
Let's go back into some of the broker moves broadly on stocks that we're watching for you. ALS today, Morgan's cutting this one to underweight from equal weight. And there we also have Macquarie. Well, this is all sort of just background to all of this as well. That full-year net loss of $240 million flagged yesterday. Macquarie, though, raised its price target to 375 from 340. Citi cutting 5% there to 370 apiece. UBS moving on CSL, downgrading it to neutral from buy. Lifted the price target, though, from 113 right up to 126 a pop. Remember, it was once neck and neck with CBA to smash through 100. CSL did just that. CBA today, FYI, 77.43.
Yeah. Different businesses, though, different growth profiles as well.
And the sort of ex-Australia story par excellence, right? Few can claim that, right? Few can claim to have broken the back of foreign markets quite so adroitly as CSL.
Definitely.
Bell Potter, Patty's Foods in its sights. Remember, of course, this one subject to a private equity push or tilt from Pacific Equity Partners. Bell Potter now moving to a hold position from buy, raising the price target to 165 from 145. Panel thoughts on that one? Private equity snooping and looking at the data room and all the rest of it.
They're looking for great returns, and it's certainly a very buoyant market when you're looking at private equity and those participants globally. And it'll only continue because people wanting returns at that sort of price point, and for those opportunities, they're seeing certain sectors are absolutely washed out, and other opportunities are there: healthcare services, new technologies, and innovation. So
I think that's a start to sort of leaning towards the China consumer story too. Maybe they're seeing that sort of. Some of these companies like your Blackmores and your A2 Milks and those sort of things, the growth that they're experiencing, probably not seeing as much in that part of the space at this stage, but maybe they're seeing that as an opportunity for them as well.
Strip out underperforming parts of the ops, then list in another 3 years, and maybe list in Hong Kong.
Don't be cynical.
You never know.
Because what's interesting is that China has not been at the vanguard of this.
No.
Right? This is still very much oldie worldy PE. Right? The old badges, the old name badges are all too familiar. Are you disappointed in a sense that China's not knocking directly? It's sort of a bit hesitant, a bit like Xi and his reforms.
Well, I think it'll pick up as each year rolls on. I think the knock's going to be a little bit louder.
I think you'll find they are, but not in the listed space. I mean, you look at they're buying up land with dairy farms. They're buying up land with cattle. They tried to buy the capital stations. I forget the name of them.
Cubby.
So they are, but they're more going direct and buying.
Out of the glare of the market.
Well, out of the glare of the market, but in the glare of the political space. So there's a lot of banging the drum and saying, why should they own these assets? But you know what? Go back to the 80s, and the Japanese were here buying coal mines and hotels and things like that, and there's no difference,
And you can't, frankly, have your cake and eat it too. If you want the asset, you have the scrutiny.
And ultimately, all the politicisation behind it, all it comes down to is get them to pay their tax. No big deal.
We've got to pay our bills on this show. We're back with the panel, and Tony Farnham joins for his discussion and insights after this. Stay with us.
Live on Sky News Business, this is Trading Day, the close.
Second hour of the programme. Great to have you with us. This is the final trading day of May. Into June, there's lots of risk in store. There always will be, and there always was. So what's new, Pussycat? Well, the fact is we snapped a winning streak today at the very least to end lower by just over 0.5%. In for the ride, in for the second hour. We have the panel extraordinaire, Pete McGuire from XM.com and from Ord Minnett, Francesco Destratus, joining the show for the second hour. Gentlemen, welcome to you both. Lots to mull, and we will also be getting a pulse check on the commodity piece too that we've at the moment sort of left idle, but it's very much alive and well. Pete McGuire with some thoughts to drive discussion on that in just a few moments. But let's also tick off what was doing the rounds today on other eco data domestically. The Reserve Bank, with some figures on lending to companies for the month of April, good gains on year, up 7.4%. That's the biggest rise in more than 7 years, those record low rates and a weaker currency encouraging businesses to go out and exercise those so-called animal spirits. Lending to companies up 8% on month. Meanwhile, loans to buy houses rising just on 0.4% from March, with a 7% rise annually. That does, though, point to a softening in demand, and as Pete was saying a little earlier, maybe this is a market that's maxed out to the minute. And of course, to make that play on housing, you've got to have a wage. The lowest paid workers are going to receive, indeed, $15.80 a week. That's not enough, is it, to finance anything other than a shoebox? The increase falling below the $30 a week rise that the ACTU wanted, but above the $7.90 to $10.50 rise business groups had lobbied for.
Common ground.
Well, yeah, sort of halfway house, no pun intended. Fair Work Commissions lifted the minimum wage 2.4% to $672.70 a week from July the 1st. That is, on an hourly basis, $17.70, with the president of Fair Work saying the increase won't lead to inflationary pressure and is highly unlikely to have any negative impact on employment. Not so, say, the likes of AI Group, the Australian Retailers Association, either, or the Chamber of Commerce and Industry. They've come out swinging with their bats. 1, 2, 3, crack. 1, 2, 3, crack. 1, 2, 3, crack against that decision. Signs at the, and we're going to get on to some of the detail on that and look at some of the hypocrisy as well that's been playing out at the coalface, pun intended, coals, right? Just hold that thought. Coals and payment.
Yes.
And double talk. Anyway, signs that the resi construction boom ain't yet over. Building approvals have beat expectations for April. Markets said they'd go down, not the market, the economists. The reverential economist community said declines of 3%. Funny that. Yeah, exactly. Sniff the wind. They rose 3%. Back to your doghouse. And do a little bit of snarling away because you are in.
Those figures on building approvals are always volatile. And you know, you could have a month of councils being efficient and getting a lot of approvals through, and then you could have a month where they're inefficient. They are seasonally adjusted, but and you got to remember those building approvals numbers may not necessarily turn into activity. It's only pre-activity, so at least they're approved.
Let's go back on that other story, though, the minimum wage. Here we have rubber hits the road evidence of the complete furphy, that is this negotiating pact that certain representatives endeavoured to strike with Fair Work. Because the ACTU, on reports, inside Coles, brokering a deal, one of their shop groups, the catering... I
think it was the shop stewards union.
Shop stewards, to underpay Coles workers to the tune of what? I mean, some amount. Now there are undertakings that are being sought by Fair Work, correct?
Yes.
Coles on
look, this is not. There's 77,000 workers, tens of millions of dollars in. They have to pay them in higher wages. Now this is not an isolated case, if you like, where a large company has underpaid workers that are actually the unions have come to an agreement with the businesses
to underpay
them. Now, it is extraordinary, and the question I have, without being too politicised, is why am I paying my union fees if you're not going to bat for me, you're going to bat for yourself. Right. So Coles have got some answers, some questions to answer. The article I read said, now there's question marks across some of their other businesses, which might be Bunnings, and they rattle off a few other names as well. So, it's a bit of a concern, I say. But, go back to the minimum wage. The question is sort of, we talked about this off air, how many people are on minimum wage? I think you'll find, that... Negligible. Yeah, and I mentioned the industries, the retail industry is probably one of them that would be. Yeah. But, if you look at something like the building industry, you wouldn't find anyone on minimum wage in the building industry.
Yeah, just to turn up, you'd have to have a guarantee of more than that.
Yes.
Right? Yes. I mean, thoughts, though, on that, just because as we pivot into services, and we are having this sort of polite, sort of at arm's distance discussion on it. But do you see this as becoming problematic for business, for Australian business, at the lower end, the small, medium-sized businesses that are being told as of today, never mind penalty rates, this is going to be life as you know it, and it's above inflation. And certain interest groups are saying that that just doesn't accord with reality.
Well, of course, but employers always... There are two sides to the argument. There's the worker and there's the employer. And the employer of the people always say that we want to have... we want that price. Sure. We don't want to absorb new costs. We're trying to run this efficiently and effectively. And then you've got the other side where people are on $17.70 an hour. They're probably over-delivering as far as work. They've been hit, and that example by Coles, and so in turn, you know, the cost of doing business, people want a fair pay for a fair day's work, and I wouldn't be surprised to see those further ratchet up.
I don't think the minimum wage is an issue. I don't think it's going to have any problems with inflation. Right. I think it's, you know, penalty rates, like you're saying, is some of the concerns, because the penalty rates, from what I understand, talking to people in small businesses that operate on weekends and things like that, is the penalty rates kill them. They'd be happy to pay more, but the amount that they pay more on a penalty rate is too extreme. They're better off closing.
That's true.
Or don't have staff come in and just work it themselves. You know, small businesses. So I think it's the mix that needs to be looked at, not necessarily the actual level of the minimum wage.
The problem is that when you try to do that on a weekend, for instance, you turn up to a mantra, which is, I mean, that's one on some people's preferred watch lists, to raise to a hold from sell by Moelis today, incidentally. But if you turn up to a proposition like that on a weekend, a busy time for occupancy, and you've cut to the bone in your kitchen and your floor staff, so that when you are going in for breakfast, you cannot be served for 45 minutes on an order. That leaves a bad taste in the mouth, right? And you're not going to go back.
No.
And so you get one chance in the services economy to get it right.
Yep.
Right? It's not just prices.
And with social media, it talks very, very quickly about you know, buyers' expectations or customer experience, and that can be shared across a platform, and all of a sudden, through trying to cut costs or trying to be effective in your management structure, you can be eaten alive.
Well, let's talk alive to Tony Farnham from Patterson's, listening in on all of that. He's in our Sydney CBD studio. Tony, welcome. Thanks for waiting. Your thoughts on where this takes us next, because we've got other data today. We can focus on the positives, and that's to say the inputs into GDP tomorrow, primarily coming from those trade numbers as well. What do you make of this? How to explain it?
Well, the real hope was there that the net export side would do the heavy lifting, because some of those other sectors like consumer spending, and also as well, of course, the capex numbers and inventories yesterday were not going to deliver too much growth. So we get 1.1 percentage point kicker to GDP from net exports, and a lot of that's because of the volumes effect in areas like LNG finally coming through.
What about offsetting that, some of the data from earlier or late last week and into this week? So you've got push-pull. What might detract from the good numbers today, what we've seen in the last 48 hours?
Yeah, well, get retail sales soon again, and I think you'll find that there'll be a degree of cautiousness there. They'll adjust that for a late winter and all these other sorts of effects. But the bottom line is consumers are not going out there and spending madly. They're spending to some extent, but with that, about 60–65% of our economy, household spending in goods and services, you want them to be out there firing away. And to the extent you get a minimum wage increase, that'll help a little bit, but there's no big increase in wages growth occurring across the board. So it has to be a reduction in savings, and also as well a degree of confidence that they're going to hold their job for a period of time into the future.
Let's understand the NAB hybrid issue. We were talking over it briefly with the panel, and this coming in the wake of the ANZ issuance, as well as a CBA Pearls offering earlier this year that didn't quite fire on all four cylinders.
Well, it did afterwards.
It did afterwards, but it took some cajoling.
Yes.
Right. So on that basis, put this one up alongside, and what do you see?
Look, I see the banks continuing to come to market with these for the simple fact that people are seeing lower money market rates. They're full of bank shares themselves, so they're saying, how can I get something else, even though they are related to that bank, of course, and they have other provisions to potentially get them shares if things go bad, and they're looking at them and saying, bank bill rate 2% or whatever it is at the moment, add in another 5% or thereabouts, and fully franked, we're getting a reasonable return, thanks, in a low inflation and low interest rate environment.
Key risk being what?
Sorry, Mr.
The key risk on this, though.
Well, the key risk, and they're miles away from it, the key risk is those notes that you've got get converted into equity, and they'll get converted into equity if that provision is activated at prices quite a bit below what you invested there at the moment. So that's the key risk. The upside risk, if ever the Reserve Bank were to move on rates, and you got these to these ones, I think, to 2024, the upside is if the RBA does start increasing rates further down the track, you leverage off that. So you ride that increase in the front end of the curve as well.
A vote of confidence in the markets today. Richard Coppelson calling out a coalition win for the election now. So the status quo prevailing at the cost of some 9 seats. That's his call. What would you say that does to general market mentality now, if he's right?
Well, Liberal governments are always considered to be more markets friendly, so if these calls become louder, you'd have to think that there'd be a little bit more confidence come into the market in the lead up to the election. But hey, we've still got 4 or 5 weeks to go, and there'll be countless polls before them, and I think there'll be twos and throws in the meantime. And then people get into debate, does the incumbent government win seats they got better, and ditto for the opposition?
I think, Tony, I think the key, that's Francesco here, sorry mate, I think the key though is in the Senate. What sort of seat, what the makeup of the Senate's going to look like. And I think that's the key to this
impasse
election.
or clear the decks.
Clear the decks, and then there's some clear numbers there that government can form government and get policy through.
Other sort of fly in the ointment, and be warned, is that a note to speed readers, whenever you see a question mark, it's a non-story because they don't know the answer. But Coppelson does say US sell-off coming, question mark. Operative words being sell-off and question mark on the punctuation. Does anyone really know, or is that just again to try and throw a bit of a fly in the ointment alongside that other comment on the election?
I'll put my head up and say, look, expectations of rate rises in the US. Then short term, yes, possibly there might be a bit of weakness in the US market. There always has been. If you look at the history of rate rises in the US, markets for the 6 months have come off. But post 6 months, they start to rally a bit more, because obviously you put rates up when the economy is strong, and if the economy is strong, businesses succeed. So I think there's going to be a bit of negativity in there, but I think that'll be followed by some positives.
And what happens, of course, as far as the Brexit and leading into Mr. Trump or Hillary Clinton?
My goodness me. Tony, you get the last word. What is it?
Look, I think rate increase, but is there the talk of one more after that? And then, of course, juxtaposition with that, the hope of a recovery in earnings in the US. If we get that, we can wear a couple of rate increases.
Good to have you with us. Good to have you with us, Tony. Thank you.
See you next time.
Tony Farnham from Patterson's. We are into a break. On the other side of it, we're into soft, hard, industrials and all the other points of the compass. It's Commodity Corner after this. Stay with us. Nice to have your company. Into materials, energy, and then a broader commodities story around it. Today, though, that was the trend. Not your friend if you were in that space. Interesting how Fortescue unwound from a lead position on securing that contract for the second Port Hedland harbour extension, or words to that effect, just to be precise on it. It was the towage licence at Port Hedland. It's won the second of those, and so it's seen as relatively lucrative into the future. It came after market close yesterday. The stock was rallying early on the session, but it gave up those gains to finish where it's at there. Losses for BHP and Rio, so no surprise that the market just eased back and went below that 5,400 level in the event, not least of all because of the weighting of BHP and its contribution to the overall market position. Switching to energy, with a clutch of losses, no upside seen on charts there. Worst performer Woodside with a 2.4% sell down, and of course you've got to look at some of the contributing factors anytime you get the big play, the big producer in the sights of sellers. Well, you can look back on the broader price action itself, get a feel and a tempo read on that, because we have an OPEC meeting in Vienna days away now. And certainly a lot to prove, not least of all from the chairman of Aramco, Saudi Aramco, former chief exec, and then the chair, Khalid Al-Falih. Certainly the scrutiny, the way the FT describes it, awaiting him in Vienna this week, unlike anything the new minister for oil in Saudi now has ever faced. No deal to freeze or cut production expected, but as every word will be passed for meaning, I'm quoting here, from the moment he touches down in the Austrian capital, he will be pursued by a press pack hungry for his view on the oil market. We've got London Brent, North Sea Brent, trading at around 50 a barrel, but failing to get above that level. Let's bring in the panel, Pete McGuire and Francesco de Stratis. What takes you above it when the base case for OPEC is there will be no cut?
Sure.
And yet it would seem that the momentum is dragging us back there regardless.
Yeah.
How does that explain?
Gee, I tell you what, when you think about what the futures market has done and some of these trading sessions, it's just been, $3 and $4 moves over the last couple of months in a night session.
Because it was 13 January. It's rallied 80%.
Exactly. I mean, it's just alarming. And so when you're taking on board what's happening with Iraq, what this meeting is on Thursday, and how that all plays into the big picture, I think you're going to have resistance above 55. Maybe you might touch 60. If you get some problems as far as some geopolitical further concerns in that Arab Middle East area, if it touches on the next part as far as El Nino, and you have weather outages and what happens with the rig count and so on in the Gulf of Mexico, they can all play into it. If you put your mind across to the shipping industry and take on board what's happened there, I mean, it's one of the worst years on history. You've got ships, and you've got so many more ships coming, or vessels coming online because of the boom times in 13 and 14. Everyone went out and ordered more ships. Right. So you've got oversupply, and then you look on board what's happening with iron ore. It's ahead of the curve, because what you experienced in December at 37, you went up in April, you're at 68, and now you're around that 50 mark. So it feels as though the crude market's following in some way. It's lagging behind about a month or two behind the iron ore price. So it's a wild one at the moment.
The other complicating factor on this for markets is the likely listing of Aramco, Saudi Aramco, and with it the expectation that you have a reform agenda that you're partly motivated to adopt because of market scrutiny now being upon you. That could also involve as some are saying, a quite radical, drastic increase in output in order to meet the market's, this newly listed entity, or at least a part of it, to meet expectations on figures into the future.
Well, you've got shipping jams. To put, I suppose, some context about it, the Middle East, certainly around Singapore and in China, you've got shipping jams with just vessels awash with crude oil. The world it's simply producing too much. You've got the rig count coming out of Baker Hughes, and it's still in decline. And until you get the big guys in the States back on, as far as the fracking and so on, when they return, we're just going to see again, larger outputs as far as oil. So I think that's going to be the drawdown, and that we spoke about it earlier, about an hour back, as far as deep out of the money put options and the implied volatility. So traders are saying, and speculators, are we going to see a big correction, $5 or $10 over the period of, say, 3 or 4 months out, and they're taking that insurance, and that's their play at the moment.
A downside correction.
Yeah, they're just saying, well, if the market comes off quickly, markets, as we've experienced, they're very volatile, and by nature, when they wash out, they're brutal. So that needs to be factored in there as well.
Because you're talking about that awash with crude story. The market had been latching on in the last few weeks to this balance.
I think we're a long way from balance.
This equilibrium, well, being around the corner.
But I think one of the key points you make is the fracking supply in the US, and a lot of those companies had forward sold contracts when the oil price was over $100. Exactly. Now those forward contracts are starting to expire. Right. The question now is, are they at $50 producing profitably, or are they not? Open for business? Are they open for business? So I personally think you'll start to see some of those fracking plays start to shut down. So that's going to have an impact upon the supply side. Okay. On the demand side, I don't think demand side's changed a great deal. Right. I think demand's increased, just not at the rate that we increased our supply over the last sort of 5 to 10 years, and that supply side correction start to come in. I think you're right with the volatility. We're seeing it in the iron ore market. I mean, who would have thought? 21,
we're at $68. We're now at 50.
Who would have thought the iron ore would have jumped 20% in one day there a couple of months ago? And supply and demand hadn't changed overnight.
Okay, what's changed though about the relationship between the Iranians and the Saudis? Because, correct if I'm wrong, all the
I know they're not going to Hajj.
They're not going to Hajj, other than to trample each other.
They've said they're not going. So
that would be a deliberate trampling. Yes. Correct? So, I mean, to paraphrase, there is no love lost between the two sides.
None whatsoever.
I don't get it how then you get an equalisation on production if they're both determined separately because of Saudi Aramco and because of Iran's got a lot to basically catch up on lost revenue, how they both don't go pumping up the level.
And then you've got Russia, you're thinking what's happening as far as Nigeria, and you've got Iraq producing at record levels, and they're suggesting they want to produce even more again. So all of that plays into the big picture, and it's going to be one interesting meeting.
At what point has OPEC ever done what they've actually come out of a meeting and said?
There's the other side of it.
Everyone walks away and go, we all agreed on something, but they go and do their own thing anyway. Sure. So I think it's more of an announcement rather than anything else that OPEC made.
Okay. Let's go into something a bit more tangible then, where things do happen by dint of forces even beyond your own control. The ag space. Vietnam, droughts.
Yeah.
I mean, who would have thought?
90 years, well, it's worst in 90 years, and that gives you some sort of indication. And when you're thinking about rice, and it's such a large staple, 60-odd% of the world's population having it daily, third largest global producer, so after the likes of India and Thailand, so it runs in number 3, and what impact that's having as far as demand, their production numbers are well down and so on. So all that needs to just be considered. Many speculators, again, and producers are trading markets and realising that there's price opportunity, and you roll your eyes across where one market's been affected greatly, and then the other one is that you've got a bumper coming on as far as the corn market, and would be one of the largest in histories out of the US. So that again, food light. We're looking at the ethanol, and the ethanol debate hasn't come back into play. No. If you put your mind back why we were worried about the oil market, and we had those those raging wildfires in Canada, and what impact that had to the tar sands, of course. Yeah. So when you're thinking, well, what price does oil have to get to increase as far as ethanol production, so that trade-off comes in, because you've got record corn production, so are the animals going to be better fed? All of that takes on board because it's a wonderful feedlot. So it's going to be interesting, and again, more volatility as each month rolls on. I don't think necessarily inflationary, because if you're producing more, maybe it's going to be cheaper.
And
this is the challenge again for farmers, but it's a tough old game to. We all know that it's a tough old game to be in.
Tough old game as well, and you touched on it, iron ore, and anecdotally coming out of China, a lot of these regional steel ops, these big blast furnacing processing units had been told they were unproductive, they would not be coming back online, but contrary to that, you hear reports of these communities getting very optimistic and excited because they are back in business. What's going on there? Because, correct me if I'm wrong, you've got they've got the speckies still moving the market. Yep. Those that can't get into Macau, so they're jumping online and buying, spot iron prices.
Yep.
And then you've got the local authorities defying the central government on whether or not these plants are on or off. Which is it?
how would you know? I mean, it seems to be a rule to themselves, and that leads us to, you look at the large players, the Rios, the Vales, and of course BHP. You look at production numbers, you look at what it's costing to pull it out of the ground, and then you're looking at the consumption and what's happening with steel producers over there. It must be a field day when you put your mind across. Think how cheaply that they've been able to buy, and they do it time and time again, when they've been able to build up stockpiles. There must be that much steel over there and that much iron ore, and they did it with copper, they've done it with nickel, they've done it time and time again over many, many years.
Yeah, they try and manipulate the market, and they did it when there was annual contracts before iron ore was market traded. What they'd do is they'd stockpile it on the wharves, so when the negotiators had come in, they'd see it all sitting on the wharves. Didn't matter towards the end there when they were negotiating, there was that much demand for it. The price was getting negotiated up 25-30%. But the market trading side of it is that unfortunately, previously it was just the producers and the manufacturers that were involved in the market. Now we've got speculators involved in the market. That's why you're getting that volatility.
And you get a line by Bloomberg saying that authorities seem to have succeeded in scaring off the retail investment crowd that swarmed into commodities in March and April. How did they do that? I mean, I've not seen reports as to how they succeeded in scaring off the speckies. How would that have happened? I mean, it's just an openly stated assertion. But how?
I don't necessarily think they've been scared off. They look for return, and they look for markets that have got movement, and that's what a speculator does. And they don't stay in markets for long if there's no trend. And they've probably shorted it and done very, very well on the iron ore market. They've been long, and they've been short gold, of course. They've been long energy, and all of this has been a great trade. You think of what April and May's done, there'd be a lot of speculators don't need to trade in June or July. They've made their money. It's been a great time.
You touched on gold, so what about that? Because people are wondering where to. I mean, it picked up some ground in Asian trade, having lost ground.
But the trend's been down.
Short term, I think
that was on the back of Memorial Day. I think there was just probably some profit taking, and of course, the next week's going to be interesting. I'm waiting to see what happens with the OPEC. Let's wait and see what happens as far as June and July are concerned, with Brexit, and then leading into US rate rises. So it's going to be a tough old time for gold to be back above that 1,200, 1,220.
And on that last point, you would think, I mean, there's the push factor. I mean, if the Fed's seeing inflation, yes, you're buying for that reason, but in lockstep with that, the dollar is suddenly, everyone's rushing back.
Of course.
Who hasn't taken
but if the Fed starts putting rates up, then, the old storage of wealth, instead of holding gold where you're getting paid nothing for it, you can actually start sort of leaning back in towards treasuries back in the US, and you're going to get a little bit for it at least.
Speaking of which, we worry and we wonder how that moves the local unit, the prospect of a June rate rise, what that does to equities as well, companies with that key offshore hedge exposure with ops beyond Australian waters. So further insights with the dollar connection at the forefront after this break. The Reserve Bank would be mightily pleased since it's gone on its rate-cutting spree, or come out of hibernation to be more precise, as of last month, and delivered that sub-2% cash rate. We've seen the dollar unwind from around about 77 US. Well, that's the equity market story. Can we look at currencies? Because that's what we're now talking about. It's fallen there to that level, 72.34. Panel, it's been interesting because in the wake of that RBA cut, they've not exactly gone on the front foot to jawbone heavily. It's almost as if the market, in lockstep with falls back down for iron ore, has done a lot of the easing for it. Right?
Sure.
Until you get up to what now, 76 again, they're probably not going to be that fast. Even going into a meeting next week on rates. What are your thoughts, Francisco?
Oh, look, I think they'll leave rates where they are this week, next week. But I think that movement in the dollar was just a reaction to earlier this month with the rate cut. And obviously, we're expecting, as we've been talking about on the program, the US to put rates up. That's going to have a negative impact upon the Aussie dollar. And, we're probably expecting another rate cut between now and the end of the year, and that's that's going to have a negative impact upon the Aussie dollar. So,
because on that basis, the Fed raising rates will have a negative impact because it will put upside pressure on the local
on the
unit
Aussie,
still.
yeah, on the US. Sorry, yeah.
But then the RBA cutting will actually negate that, or at least take some of the sting out of it. No,
it'll work in the same direction.
Upside pressure even if the RBA cuts.
Downside pressure to our Aussie dollar. Exactly. Yeah. So the US putting rates up is going to have upside pressure on the US dollar and RBA.
Do you not see? Okay, do you see it quite that way, or do you see that long trade being awfully crowded? That there's not a whole lot more degree of upside for the greenback, and that yield story will still see support for the A dollar even after a Fed rate rise.
Fifth highest traded currency in the world. Not bad for a little, 22 million population. There's certainly one thing that turns traders on: volatility and opportunity. And they're the two main ingredients at the present to really get, and we're talking globally, the huge concentration as far as money that enters our market and pushes it either higher or lower, can assist it very, very quickly. So I wouldn't be surprised to see further upside for our dollar in the short term. I think there's just too much momentum out there, and it's going to be hard to contain it. I think we're a fair way off from that high 60 level. I think it's got, it's on an upward trend at the moment.
So you're saying even though Janet might even raise in June, July, or latest August, right? Let's just create that little bracket of time.
I don't think we're going to go back to that 74, 75, but I think it's going to be range bound between 72 and say 73 and a half, maybe high 73s.
Well, guys are saying 65 by the end of the year, so we're saying it's going to keep heading south.
What would you be changing your sector calls on, or at least your stock allocation towards, based on that? From
an equity point of view, obviously you want exposure to US dollar. So companies that are either earning, funds in the US dollar or operating in the US dollar.
James Hardys.
So the James Hardys, the CSLs, those sort of Brambles. Brambles have been a great performer. Aristocrat's been another great performer. And not just because of currency. Their operations have been very good. Add to that a little bit of currency inflection, and you got some really good performance.
Are they liable?
Oh, look, I don't think so. Anyone's liable to stumble, but I don't think they're priced to perfection. Definitely, Brambles, I don't think is for sure. I think that's a very strong business. If we're seeing the US economy improving, we're not going to say that it's going to grow out of sight, but it's improving. Then Brambles benefits from that as well, from an operational standpoint. And then you got the currency flip as well. Those that are still holding QBE, I think there's some benefits there as well, and they've started to tidy up their shop also.
Okay. Any that have fallen out of favour on that same kind of argument that you've heard from recently with the outlook? Because, Flight Centre, for instance, pushing big into North America. But margin squeeze in line with price deflation globally on the air industry. So do you lighten the load on a Flight Centre, or are you a true believer and say they've ridden out recessions before, they've ridden out turbulence, they'll come out to some clear blue air and be stronger?
I'd be cautious. In other words, take something off the table. If you love the stock, but take something off the table there. Qantas, I think, it's had its day in the sun. Personally, I think the oil price is going to head a little bit further north from here, and that is going to impact upon the likes of Qantas. And Virgin, funnily enough, we were talking about them earlier, hasn't benefited as much as Qantas on the oil price. And their share price hasn't done as well. But
because the hedges sort of...
The hedge,
exactly.
Where it calculated with the dollar now where it's at, where they might have locked in those hedges. Your thoughts about the ability, given the relatively small class of stocks we're talking here, it's only, one hand's worth. If you're lucky, right? You winnow it down to, say, 5.
Oh, I could throw it. Aurora is another one that's a great performer. Packaging company.
What about Amcor?
Amcor, I think it's fully priced. I don't think there's a great deal of growth in it, but I think there's, it's going to benefit from those currency changes as well. But, you want to not just look at it from a currency, because if you get it wrong on the currency, you want to look at the operational side of it as well. And I think Aurora, which spun out of Amcor anyway, is a really well-run business. It's got some solid business here in Australia. It's got some really solid business in the US, but it's got some growth opportunities in the US.
But remembering about that Aussie dollar, you know, we're talking over the short term, you know, maybe 2 to 3 weeks, possibly out to 6 or 7 weeks. But the long term, if you see 2 successive rate rises in the States and 2 successive rate falls over here, there's no doubt we're going to be that, you know, mid-60, possibly 67. So, you know, we're agreeing on that territory. The other side, of course, is how quickly things can happen. And I think, you know, everyone's saying the next 7 months are going to be very, very volatile. So I think that's going to be great for traders.
It's good for traders when the volatility's there, the returns are better.
Yep. How much of an influence do you think is a pullback in the foreign investor housing story, though, to the way traders view Australia and the dynamic of the economy? Are they seeing those headlines that they're seeing the pullback by banks on lending to offshore investors? Do they perceive that as a net negative, a reason to lighten the load?
I don't think they care, do they?
I don't necessarily think they care at the moment, but I'd say they'd have a fairly... their hands would be on the wheel and they'd be seeing what's happening over here in the next, say, 4 to 6 weeks as far as election, and they'll sit and say, well, righto, does Labor get in, and what impact does that have as far as a negative gear? And if Libs get in, well, is it, you know, back to the same old game? So I think that would be the only constraint at the moment.
I've seen a lot of anecdotal evidence in the property market, people I talk to in the property sector, that a lot of the Chinese investment, they don't care. They're not even putting tenants in a lot of these places. So, some of these, apartment developments, they're not necessarily concerned about getting tenants in. Right. It's about storing the wealth.
Storing the wealth, and maybe, if you've got to live in it in 10 years' time, they've got somewhere safe to go.
So it'll be a bit like Paris. They call it City of Lights, but actually the centre, most of it's owned by absentee, offshore... offshore owners, so that the place is half dark at night, right? That'll be Sydney.
Probably will be.
I was talking to some people today that we're talking about sort of, not apartments, we're talking sort of, multi-million dollar properties around the lower North Shore that are sitting there empty that Chinese buyers have never even walked into. So, it's anecdotal evidence, but I mean, it'd be interesting to see what the numbers are on that. Right. So I don't think having tenants in some of their investments is a real concern for them.
No. The only people that see them are the carpet cleaners.
Probably.
I don't think they have a lot of that either.
Pulled up the carpet. It's, what is it, North American oak or whatever.
It'd be interesting to know what squatters' rules are anymore.
You can put that one to the test, Francesco, suburb by suburb. I mean, what are the factors driving now? Because you talked about that range-bound nature for the $A. What, 72 to 74? You're saying
I think in the short term,
that.
3 to 6 weeks, that's where it'll trade. Remember, the traders are looking at something short. When they're either in it for minutes or hours or possibly days, but certainly very rarely are they in it for weeks. That's our, anecdotal. The customer base that we have, traders traditionally look for multi-positions, they stack positions, they look at, what happens as far as New York coming on, where is London over the next period of, what's happening tonight. It's a short-term frame. So, yes, over the short to medium, 3 to 6 weeks, probably that 72 to 74, you may see a breakout, and then... if we see corrections as far as
so rates, we're talking
down.
By the end of the year 65 cents.
Yeah, that's 7 months away.
It could go up a bit and down a bit, and we're not traders. We're looking at it from the longer term investment point of view. So I think that's the difference between what we're talking about there is the traders are looking for those short term opportunities. We're looking for the longer term.
And you can see 1% or 1% price rises or price falls in a trading session.
Yeah.
So that's exactly what traders are after.
Do you expect, in terms of the dollar index, the US dollar index, a rally up towards 100 following the rate rise?
I wouldn't be surprised to see it move. Well, I'm not. Hard to put a number on it, but certainly if you see successive rate rises and what happens as far as, I still believe that Brexit issue does cause some concern, and what happens as far as US polls.
So what do you think that's going to do currency-wise? I mean, is it going to be a negative on the pound? Or?
Well, you see what the likes of George Soros and all these guys holding large gold positions. I'm sure that you're going to take guys that are, they'll see opportunity there, and I wouldn't be surprised to see pressure on the pound. So against the euro, short term, exactly. What happens against the US dollar and against, of course, the basket.
We haven't touched on Trump.
Do we have to?
The Trump factor. Well, I think that's because the odds are narrowing, even as we sit here.
Yes.
Right on a Hillary, kind of victory just being a pipe dream.
Yeah, I think that over the next couple of months it'll probably settle down a little bit, but I'd say from September onwards it's going to be mayhem.
Look, there's a lot of harsh words being said about both sides of the political spectrum over there, but when it comes down to it, then it's not a dictatorship, and the political system over there doesn't allow for the president to actually sit there and wipe out the whole, the two houses of parliament they have over there and say, I'm making the full decisions here. Right. So there's still a balance, within the political system. So yes, he says a lot of things that are harsh, but from a market's point of view, look, I think, personally, I don't think it's going to have a real impact upon the markets in the shorter term. I think longer term it'll be interesting to see what his policies are, which we don't really know as yet.
It's only his fingerprints, though, on the codes for nuclear takeoff, though, isn't it? Launch. I mean, in that briefcase, it's his vials of blood. It's his thumbprints.
I think there was a lot more volatile people in charge of buttons in Russia, 50 years ago, and didn't do it. Of course they are, and didn't do it. I think when it comes down to it, I think people become a little bit more sensible. I think that's human nature. Right. But could be wrong. But Clinton, is Hillary Clinton going to be, the next or the first woman president in the United States? I don't know. And what impact? I think the financial markets will like that because they've been supporters of hers for a long time financially.
Have a look at Bill Clinton, exactly, and that huge run up as far as Nasdaq, and from 92 really to 0.00.
Did he have to do much in that space of time? Was it just markets free to go about their business?
Free to go. I mean, a lot of he had a great degree of headwind, tailwind, I should say, and it just blew the Nasdaq all the way. Crude prices rallied strongly. Everything was a very, very good time in the US and globally.
Well, the cogs were turning in the right time for him. Look, I don't think financial markets are going to be impacted significantly until we hear a little bit more of their policy. And we really haven't even heard much of Hillary Clinton's policy as well. So I'd reserve the judgment to sort of wait and see what goes on. I think the financial markets over there are doing the same. It'll only be when they just, really the Democrats haven't even decided who's going to be the runner. Yeah. So, I mean, it's obviously going to be Hillary Clinton, but, the Bernie Sanders is still hanging in there like a bad smell.
Another.
Did I say that? No.
Well, you can say that and get away with it. What's really good, though, what's really interesting is that we haven't even touched on the Australian election, but this idea that where's the incentive? You talk about the runaway Nasdaq for Australian innovation to find a home on the ASX rather than still decamp to Silicon Valley / Nasdaq final listing. I mean, you just think of recent arrivals to the Nasdaq from Australia.
I think the unfortunate thing in Australia is that the politicians, both sides of the spectrum, talk about innovation. And when I say both sides, I mean the whole political spectrum, the Greens and everyone. They talk about innovation, but it's all catchphrase. There's no real hard policy. They'll say, well, we're going to put 500 million in to innovation, and it might go to some education and things like that. But when it comes down to it, how do you get innovation is through investment, and to make that investment attractive.
Sciences, technology hubs.
Cut the tax take as well.
I mean, you look at CSL. We mentioned that company earlier, and it's been a great company for Australia. But where have they kicked the
big R&D grants you need to really embrace and have academia behind you, universities, think tanks, and so on. And we've got to
investors. You've got to create incentive for the investors to say, I'm happy to put some money into this startup because, okay, there's a risk there, but if it comes off, I'm not going to be impacted upon significantly on a tax perspective, or if it doesn't work, I can use that for further technological investment. Exactly. But at the moment, a lot of it is just, we're going to innovate, we're going to spend 500 million, but it all goes to a few educational institutions and really doesn't mean anything.
Panel, let's go to London.
Sure.
Let's go to London after this
Tomorrow
break.
morning?
No, after the break. Sooner than that. Don't have to wait. We'll just take a break and we'll be back to London with some opening calls in just a moment with IG. Welcome back to the show. Hoping to take you to London. No promises. The line may thwart best intentions, but let's just review our action today. Snapping a 4-day run higher to indeed just finish in the red. Oil stocks leading those declines. But if you look at on month, this is the third consecutive advance we have clocked. So not bad running, all things considered. You've got those public holidays in the UK and in the US. That's to say Memorial Day, and a holiday coming out of London as well on Monday. So there was no real direction for our market in toto today to be keying off traditionally, as we would be wont to do. So in the event, we looked at that energy piece, the upcoming OPEC meeting, a sell down in that space. The sub-index was off about 1.5%. Consumer staples as well, and financials were on the back foot alongside it. I got the panel with me, XM.com's Pete McGuire and Francesco D'Estradas from Ord Minnett. Just some final thoughts. We talked earlier on the show about the march of foreign retail. We've seen the winter sales coming early now for both David Jones and Myer because of the sudden cold snap.
You mean?
Late. Well, yeah. I mean, they would have actually been later still, but now we've got this cold snap upon us as of this week. They're coming in early by about 9 days. I think it would have been scheduled ordinarily for about another 9 days' time.
Can't please retailers, though, can you? Because they were complaining about it 2 weeks ago. Yes.
That's the real point, as you point out. What about this Aldi stealing market share? Is this just an irritant, or is it part of something more deep-seated? Peter, how do you see it? I mean, because
when you go, a couple of weeks ago, we had Mike McCarthy talk about his experience going to Woolworths versus Coles and Aldi. And when you shop across the three of them, they're very interesting business models. And they're a different offer. They're very different to a Coles or a Woolworths. You see a cross-section as far as age demographic. You're looking at the clumpiness as far as customers coming back and keep on repeating their business and their visitation. They have specials that I think are very, very different compared to the other two majors. That's their strategy. It seems to be very effective, and it's obviously what the consumer wants. And
I think what we've seen is a new competitor come to the market. The existing companies were a bit sort of caught off guard, if you like. They didn't think much of it, and all of a sudden it's actually become something that's more than they thought it would. Excuse me. The market share's ramped up that Aldi's achieved, but I think that'll start to taper off a bit now, because now Woolies and Coles are starting to wake up. So their reaction is, well, we need to adjust. We need to change our home brand products to compete against Aldi, that's what's happening. Okay, so instead of you go into Aldi to buy your $2 tuna or whatever it is, you can still get that at your Coles and Woolies. But what's different is that Aldi, unfortunately for Aldi, that most of their stores you can't do your full shop. So people still had to go to their Coles and Woolies to do their full shop. So I think they're going to find it a little bit tough this next phase, but I think what they're going to see in growth is just new store opening growth. Okay, and I think they'll see a bit of a plateau in their market share growth. They'll keep some of that market share, and I think we'll see the big two retain a bit more of that, and then it'll go into another phase after that.
Watch this space, gentlemen. Thank you as always. Appreciate it. Francesco and Peter from Ord Minnett and XM.com respectively. That is it for today's edition. Pete's along with your final count after this. Stay with us.